Hello, this is Linda Hitt. We're going to do step 2 of our accounting cycle review problem. We did the journal entries and posting to the subsidiary ledgers in a previous clip. Now we're going to post to the general ledger to determine a balance per account, and we're going to prepare a trial balance. And I've gone ahead and set up the ledgers so this could be a little bit shorter. How you set up your ledger in a manual system is completely up to you, but it kind of makes sense if you kind of put the assets together. So what I did is I listed my assets on the left side, as you can see going all the way down. These are all assets. If I were really clever, I would have put the short-term assets together at the top and the long terms to go along with the order of the current balance sheet for current assets. Then we have liabilities. Again, we could have put current first and long term. I'm not saying I did that. And then down at the bottom here we have stockholders' equity. And then the temporary accounts, dividends, which would be closed into retained earnings at some point. Revenues, contra revenues. Gain is actually a revenue. Let me go ahead and see if I can put revenue next to that to remind us. And then we have expenses below that, so these are the expenses. So again, the purpose of a general ledger is to determine one balance per account. Software, of course, can do that for us, but if we're going to just work all the way through a manual system, then what I'm going to do is take every debit, every credit from the general journal, transfer it over. So here we have cash of $100,000, and I guess let me just link it, use my Excel. It's a debit in the journal, it's a debit in the ledger. And then I'm going to do go next to common stock. If I don't have that set up a separate ledger for that. And I'm just going to link it. And then additional paid in capital we have, if you remember, when you issue stock at par value, the difference between par and market value would be your additional paid. So we just posted the first journal entry, and then if we continue, we've got land. Of course, all your assets you would expect to have debit balances or zero. Cash goes down, so I'm going to credit it and just be on the next available line. Inventory, we purchased some on account, so we should also see accounts payable changing. As a liability, it has a normal credit balance. And then more assets. We paid more than 1 month for insurance, so we've got prepaid. And then of course cash goes down. So the biggest T, of course, is the cash T, since you have a lot more activity often in that account. And then we paid the rent, which was just for the month, so it was not prepaid rent, just rent expense. And used cash. So the cash is going down, the credit. Then we received some money, if you remember from the other example, for services to be performed in the future. So our cash goes up, but we cannot record revenue yet from the customer. So we'll pick up a liability promising to do the service in the future. And then we have equipment that we purchased with the notes payable. So we'll simply move that over there. Supplies is a short-term asset, which I have all the way at the bottom. I didn't put them in necessarily any particular order. Supplies is $2,000. So we increased supplies, and we were billed for the supplies, so I need to credit accounts payable. So we have a little activity in that account. Okay, this one no entry. I think we signed a contract. So now we declare a dividend. So you can use retained earnings as a debit, or you can debit dividends. Either way is acceptable. If you do dividends, then later we'll close those accounts out as a temporary. And then we have dividends payable. When we announce it, we haven't paid the dividend yet. But it's usually very short term. Accounts receivable, which I have right here. We actually sold, yeah, we performed a service. This is accounts receivable on service revenue. So many companies would have more than one type of revenue. There it is. So service revenue is credited, and then we sold land, so our cash is going to go up. Land is going to go down. We didn't sell the whole thing, we sold part of it. And because we sold it for more than we paid for it, we want it with a gain, which is a type of revenue. So that's a temporary account. Okay, so I'll post that. Then we have notes receivables. We have quite a variety, I guess, of assets here, which is good. Okay, there's the notes receivable. What else? Cash goes down, 6,000. I'll just find the next available line. And accounts payable goes down by 20. We paid one of our bills off. So we'll debit that and we'll credit cash. Okay, there it is. And then we have a sale. No, not a sale. Let's see, I'm looking at the wrong one. Sales, yeah, it is a sale, sales revenue. So we perform a service and sell products. So our accounts receivable is going to go up. In our example, for some reason, I didn't do any collections of receivable, but I have everything else. And then service revenue, sales revenue rather, is up here. So we have 40,000. And then because we use perpetual inventory, when we sell the goods, we also have to update the fact that we no longer have the inventory. So I need cost of goods sold, which is an expense for the asset used up, 15,000, and then the inventory account itself needs to go down for what the cost of what has been sold. Okay, we have salaries. These are the people that work for us that we actually paid. And so I need to go back up to cash, which is starting now to fill up. Okay. And we have a few more daily entries, and we'll be down to the adjustments. So we paid off the dividend payable. All right, so dividends payable, the liability account will go down. If I can find it, there it is. So it's a debit to dividends payable and a credit to cash. Okay, and it looks like that's the last one, and we're going to assume we're going to need statements, so we're going to go right into the adjusting entries. It's true that sometimes it takes a while to analyze the data to figure out the adjusting entry, so there could be a lag between the last journalized daily entry. The first one we have here, it looks like, is insurance. If you remember, we used, I think, 1 month of insurance, or 1 month of insurance expired, so that's assets used up. So we're going to recognize insurance expense and reduce our prepaid insurance, which is here somewhere. There it is. And I think by linking this, I have less of a chance of making a mistake. Still have a chance, but less. And then we recognize a portion of the unearned revenue, earning the unearned, or we can also talk about that as deferrals. First, we put off recording the revenue until we actually earn it. So posting that, I'm going to debit the unearned for, again, the certain number of days that we've actually done the work, which we've described in the other tape. And service revenue should go up. So I'll post service revenue and not sales revenue. Easy enough to put something in the wrong account Okay, and we're down to depreciation, straight line depreciation on the equipment, I guess, that we have. So we will debit depreciation expense, post that, and then the contra asset will post to that as well, which is right there. Okay, and then we accrued the interest, so this is an accrued expense. So we have interest expense, principal times interest times time, 20 days out of 360, and then interest payable is with the liabilities, short-term liability. And let's see, supplies expense for 1900. We have here somewhere. Okay, so I'm going to update that and reduce supplies for the portion used up. And then we accrued interest on the notes receivable. So this is interest receivable, interest revenue. So it's an asset that we have here somewhere. There it is. Interest receivable 13, and then interest revenue should be with the temporary accounts. There it is. Okay, it's a little tedious, but that's how we enjoy having software to take care of some of the stuff. But do it once so you kind of have it, the basics. Salaries expense is also an accrued expense. We already have this account set up. We've actually used it, and we've paid and recorded payrolls that we've paid, but this is the one we haven't paid. Yet the individuals have worked for us, so we have to do an adjustment to make the salaries expense complete. Alright, so hopefully that's the last entry. Hopefully I got all the entries. And then at this point, what you would do is basically total up your ledgers. Now if you have a whole bunch of activity like we did in this one, what might make sense is to, let me do, let's see, auto sum's not on there. Total up the debit side and the credit side. So use your auto sum, total up the debits, a little subtotal here, and actually I guess I could just slide it over, hopefully. No, that didn't do what I wanted it to do, so we will try again. Let me do the auto sum over there. Okay, so we've got total debits, total credits. Normally you probably don't need to do that, and then I'm just going to say the debit side is larger, so I'm going to take the debit side minus the credit side. And we do have a debit balance, which we should for assets, whatever it takes to increase, debit or zero balance. And then you would do the same for all these others. So here we have what? Debit to land, a credit. So the net figure is 15. Inventory, similar thing. We bought 25,000. We've used up 15. Prepaid insurance. Spent 1,200. Used up. Whoops. Used up 100. So most of it's left. If it's just one number, we don't need a total. And then this one looks like it. We can do the auto sum for that. Okay, and then those are just one number. And then we have supplies, debit minus the credit, $100 left. Accounts payable, let's just do, there's not that much activity, so it's going to have a credit balance. I'm going to take the credit side plus the credit minus the debit. Okay, 7,000. This one's really easy. It's going to have a zero balance, so debit minus credit, zero. Unearned revenue, starting with 9,000, reducing it by 2,500. So fortunately, we don't have a lot of numbers to add up. Service revenue, we can just do the easy way. Skip the auto sum and just do it that way. And that might be it. Let's add up our 2 salaries expense. Okay. So I think we have all the accounts. And again, so the next step is to check to create one balance. Actually, we create one balance in the general ledger. The trial is to check the math. All debit balance accounts should equal all credit balance. And this gets us ready to do the statement. So I'm going to take the cash ledger and link it to my debit total. And then I'm going to move right on to the next asset, which is land. Bring that over, and inventory or merchandise inventory. Do the total. Prepaid insurance. In fact, I could probably even cell reference the title if I wanted to. Equipment. 80,000. Accumulated depreciation. I'm going to abbreviate. It's too long. Whoops. And that's got a credit balance. Contra assets have the opposite balance of assets. Contra accounts always have the opposite. And then we're down to accounts receivable. And that's, of course, a debit balance. And notes receivable, interest receivable. Type in some of the headings. And supplies. That'll take us through the all the left-hand T's. So notes receivable is linked. Accounts receivable linked. And supplies. Okay, I think we have all the assets. So we can move on next to the middle column, or middle column. Accounts payable, short-term liability, has a credit balance, we would expect it to. And then notes payable, 80. You don't need to put dividends payable on since it has a 0 balance. So we can go right on to unearned revenue. Credit balance, interest payable. Whoa! Getting the right spot here. Credit balance, as you would expect. And salaries payable. It's just, again, the portion we accrued that we haven't paid to employees. Okay, and then we're right on to stockholders' equity. So common stock has a credit balance of $55,000, and then additional paid in capital. Can't type. I have to do this at night when everybody's in bed and not making noise. Okay. Then I think the last item, is dividends. Sometimes you see this as dividends declared. Okay, and we're coming in the home stretch. We're now going to look at the temporary account. So we have service. Whoops. Let's see if I can do the back arrow. Okay. Let's get down here. So we have service revenue, credit balance, of course, whatever it takes, again, to increase the account. Sales revenue was 40. Gain. Yeah, I'm just going to, I guess, we'll be doing the linking. Yeah, I guess we were. When did I stop? Not that it matters. I'll just go ahead and link it like I did. Because if I type it, sometimes I can add an extra 0, whatever. It's probably safer to link, assuming that the ledger's right. interest revenue, supplies expense is a debit, and rent expense. And what else do we have? Cost of goods sold. And salaries. Insurance. Give us some detail. Just abbreviate it since I can't type. Insurance expense, depreciation. And that's okay. Interest expense. And that's probably it. That's good. Okay, so if we picked up all the accounts, the proof of the pudding, and again, if it doesn't balance, we don't want you spending all your time trying to get stuff to balance. So, you know, check the numbers. If let's say the difference is $10,000, it could be you put something on the wrong side. Maybe look for a $5,000 item. So there's a couple little tricks, but don't spend more than 10 or 15 minutes. Let me see if I can get all the columns. And then just go on to your next step. We do usually have links to solutions for most problems on Blackboard. Okay, and if I do the same thing over here, bring it all the way down. Let's see. And of course, the two sides don't equal. Which is probably very common. I would never get this to work out the first time around, I'm sure. But I did work it out once before, so I'm going to sort of skim over this and see if I can spot my error. And you know what? When I first did this, I made the same error. Well, at least I'm consistently wrong. Notice that I credited dividends. So let's do something here. If you take the two sides, and of course this only depends if you have one error. The difference is 11,000. So this is what I was mentioning. Since I put the dividends on the wrong side, 11,000 divided by 2 is 5,500. So that's the kind of error you could catch if you divide your difference by 2. But if it's more than one error, then of course it's not going to help you. So, you know, do the best you can. Thank goodness for software. In the old days, you spent hours looking for stuff in businesses. But our purpose is for you to understand the statements and the relationship between statements and the journals. Okay, I hope my number is equal and it's the same numbers I got before, so that's a good sign. So we're going to conclude this video. We'll have a separate video to do the statements.